Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, it's Agostino. Deferring your income and leveraging tax laws are some of the great ways and some of the biggest benefits of building your real estate business. The key though is having the right person on your team that knows how to apply these rules. Well, today's guest, he understands how to shelter the wealth that we create and helps professionals execute a passive capital gains tax deferral wealth plan. Now, he has developed a solid tax strategy. So when it comes to the capital gains, and he focuses on helping other people solve their capital gains challenges when they go to sell off their properties. So he is the CEO of Capital Gains Tax Solutions, and he also hosts the Capital Gains Tax Solutions podcast. Now, with all that, I'd like to welcome my good friend, Brett Swarts, to the show. Hey, Brett, thanks for coming on, man.
Agostino, thanks for having me. My pleasure to be here to serve your audience.
Yeah, thank you. Thank you. I think it's going to be great. It's going to be great. Well, if you like what Brett has to say, you can reach him via his website at capitalgainstaxsolutions.com. And if you like our content, please don't forget to leave a comment and rate the show. And finally, if you text the word freedom to 202-410-4202, you're going to get a free ebook, The Bulletproof Guide to Finding a Broker. Okay, Brett, go ahead and tell listeners about what you do and how you help them.
Absolutely. So most high net worth individuals, they struggle with capital gains tax when they go to sell their commercial real estate, primary home business, or other highly appreciated asset. And we use a deferred sales trust to give them what's called a transformational wealth plan, which essentially gives them tax deferral, liquidity, diversification, and the best part, I think, for your commercial real estate listeners, the ability to go back into real estate at optimal timing, not ever having to worry about the pressures of a 1031 exchange ever again, so they can create and preserve more wealth.
Okay, that's a lot of stuff to unpack. All right, well, let's start. Let's start from the beginning then. So let's try to take it down to a person that maybe uses a 1031 to buy a flip asset, for instance, right? How do you help that specific person shelter their gains when they go to sell that asset, and what all can they do with that money once it's sheltered?
Sure. Right. So depending if it's short-term or long-term, so if someone is flipping, short-term rentals or flipping houses, as long as they're not a dealer, right, essential, or even if they are a dealer, you're going to be challenged with either short-term or long-term. Remember, 1031 exchange only works for long-term capital gains tax, which typically means you're holding it for a year or greater at least. And so that's one of the challenges with the 1031. It's very restrictive. I liken it to like the old Blockbuster. I don't know if you remember, you used to go to Blockbuster and you had to rent the video, you had to show up, you had to see if it's behind the cardboard, you had to bring it back in a short term, and then you had to pay the fees if you didn't rewind it. That's kind of like the old 1031. It's the old way of doing things. And there's a new thing called Netflix. And guess what Netflix allows you to do? A lot more things seamlessly and easier and just more beneficial to you and save you time and energy. And that's what the deferred sales trust does. And so, for example, the first one is short-term versus long-term. So we can defer capital gains tax short-term. So for anyone who flips houses out there or flips properties and it's under the short-term, instead of paying all that tax, and by the way, that short-term is considered ordinary income, which is not good. You want ideally capital gains tax treatment that's lower rates. And so simple, you're selling, let's say, a house for $500,000 that you bought for $200,000. We can roll that into the trust and defer all the capital gains tax there. And you do another one, you keep doing that. You just keep rolling it into the trust. And the idea is to not pay the tax or to defer the tax, right? And we define that as winning. We define losing as paying the tax.
Excellent. And because many people, they want to make the move to multifamily, for instance, right? And they often see doing these flips, like say, take an asset here in Cleveland, for instance, people are able to buy a house for $5,000, $10,000, and they'll go in, they'll do a bunch of repairs, and then maybe get 50, 60,000 out of it. Right. So it doesn't happen very often, of course, but when it does, they get all that gain. And conceivably then it sounds to me like they're able to take that money, put it into a 1031 type of account, and then keep on growing it the same way you just mentioned, and then eventually invest it all into a multifamily deal, all pretty much tax deferred, right?
You got it. Exactly. So the key thing here is consolidation, especially for people who own multiple single family homes. One of the biggest challenges is trying to do a 1031 with, let's say, a 20 or 40 unit portfolio of all single family homes, because in order to sell that, it would be kind of a nightmare to get a 1031 under the 45-day window and 180 days to close, because you have to have them basically all close at the same time. So before people find us, what do? Well, they would sell it to an investor who would want a 20 to 30% haircut on the deal, and they'd buy them all in bulk, and then they would do their 1031, right? But that's not very good, because they just lost 20 to 30%. And so the solution is the deferred sales trust. You could just sell each individual house one at a time and move it slowly into the trust. And then once it's all, and by the way, when you're selling it one at a time, that means you're probably selling it to a primary home buyer, which can get FHA financing, can pay that 20 to 30% more, or fair market value for that homeowner, versus just an investor. But now once the funds are all in the trust, yes, up to 80% can be used the next day to go buy investment real estate, such as an apartment complex. So let's just say it was a $3 million worth of, I don't know, let's say 100 homes, right? Well, now you sell all of them, you defer, let's say, $1 million in tax. Instead of having 2, you have 3. And then the next day you can use those funds, kind of like a self-directed IRA, to purchase a brand new, apartment complex. Let's say it's 100 units, right? And you put a down payment down on, and now it's all tax deferred, and you're owning it the same way you would have had you done a 1031, albeit just at any time, not having to do it within 180 days, which is really the key here, because what we're seeing right now is timing makes all the difference, right? If you bought before Corona, you probably bought at the peak or close to it, and now it's post-Corona, and we're seeing more deals come up that are more favorable for buyers. And this is what we call optimal timing. Buy when it makes sense for you, not when you have to via the strict 1031 exchange guidelines.
And that's the thing, though, too. I think that when people understand these guidelines, they're able to use them to their clear advantage. That's one of the biggest and best ways, like I said at the beginning, to build such massive amounts of wealth. Now, in terms of passive income, what sort of strategies can someone apply then when they do have a bunch of these rentals, let's say, for instance, and they're getting some cash flow from it? How's that taxed versus, say, a W-2 income, for instance, which is, I know, is the highest tax of all, right? But how do you delineate and how do you compare these two?
Ideally, you're getting depreciation to offset the income on anything that's either active or passive for commercial real estate. That's one of the number one reasons to own investment real estate or a business, is for the depreciation to offset the income. So I'll give you a deal story. We just closed a deal in Cupertino, California. It was a high-end primary home. It was a $3.1 million sale. And this is a Google executive who lives just a few miles from Apple headquarters. And she's in her big house that her kids are gone, and her house is highly appreciated above and beyond her 121 exclusion, which is essentially, if you live there 2 of the last 5 years, you get $250 if you're single, $500 if you're married, all tax free. But above and beyond that, she owed $400,000 in capital gains tax. And so she's sitting on this asset, and she has her W-2 income coming in, and this asset has all of this equity, but she's not producing any cash flow off of it. And so what she was able to do is she was able to sell it, not only to defer the capital gains tax, but move it outside, pay up all of her debt, move it into this trust, of which she can now invest into multifamily and dip into depreciation to offset that income. Okay, so it's kind of like a triple arbitrage. You went from making zero cash flow on the property to moving an illiquid asset that is not depreciable because it's a primary home, and deferring the tax, and then getting that depreciation. So let's just say that new asset produces $50,000 per year. Well, 20,000 of that may be depreciable, right? Or 15,000 may be depreciable. And that means the cash flow that's coming in is the same, but the tax is on the lower amount. And so that's the idea. We want to create something that's, it's called like tax engineering. We want to look at your overall estate and your different asset classes. What's in it's kind of like the rich dad, poor dad and the different quadrants. What income is coming from where, and how can we move it over into the kind of the right side of the quadrant to get tax efficiency. And that's the key with the deferred sales trust, because it can work with just about any highly appreciated asset. So for your listeners who don't already know, a primary home does not work for a 1031. Right. We're also doing a Bitcoin case right now. We've done dentists, veterinarians, optometrists. We've done car dealerships. So you can take all of these illiquid assets and you can trade them all tax deferred into this to this deferred sales trust, and then you can deploy it into a deal with Agostino. Because you might be, by the way, you might want to be completely passive. You might say, I'm not an expert in this. And a lot of syndicators, before they meet us, they end up having someone sell, like say a house for 3.1 million, pay the tax of 400,000, and then they show up with the money. And we would say, don't do it that way. Do it one other step. Let them defer that tax, save that 30 to 50%, and then invest. And so you're happier, they're happier because you have more money to invest. They have more money to invest. And it's as simple as that. We just do the mathematical equation, and then we map it out, and then we execute the plan.
Excellent. So go through that one more time then. So that case you just mentioned right now, they have a home, they're going to sell off their home. So instead of getting nailed for that capital gains, how do you defer it then? You move it into a trust?
Exactly. We just move all the proceeds into the trust, and this is essentially how this thing works. Instead of the client taking all of that income, and it was about 1.8 million after the debt was paid off on the house. If she would have took 1.8 into her personal hands, it would have been taxable, and she would have been left with about 1.4. But instead, she moves it all of that 1.8, and she directs escrow to send it to the trust. Okay. Essentially, the asset is being sold to the trust, and the trust is turning around and selling the ultimate asset to the buyer. And because we do it in that order, we're able to keep her tax deferred. It's kind of like a 401k if you think about it in a sense.
Yeah.
What can you do as a W-2 earner? Or you can send money to the 401k, right? And you can have some tax advantages for that because you haven't taken actual receipt. Right? You actually removed that income, or your employer did, or you sent it to them, and they give you that tax benefit. So we use an installment sale, which is the strategy. It's known as the seller carryback, except we just do it in a creative way. We've done a couple thousand of these now, and we're specialists in what we do. But the key is, instead of the funds going to your personal account, Agostino, they go to the trust. And now they're in a tax-deferred state at which you can live off the income. Most of our notes are 10-year notes. At the end of 10 years, you can renew for 10, and just keep going, pass it to your kids, right? And the idea is to keep the principal in place, most of our clients, and just live off the interest. Now, you'll pay ordinary income tax on the interest payments, but in the meantime, you can invest all of the principal into different vehicles. You could put it in stocks, bonds, mutual funds. You can put it into hard money lending. We just did a deal out of Georgia. It's a $7.6 million sale, multifamily owner. He's done hundreds of transactions over the years, and he was faced with the same thing, equal or greater value in a short period of time. And he didn't want to overpay for the property and take on all this debt, especially during COVID-19. And so we saved his 1031 exchange. Instead of him overpaying, he moved it into the trust, 3.1 million of equity. He no longer has to worry about that 4.5 million in debt. And now he's sitting in actually hard money lending. He's putting it there right now while he waits for a deal. And he thinks the market's going to shift in 3, 6, 12 months, but he's not in a hurry, right? He's going to wait for a deal to hit him over the head and buy at optimal timing. So hopefully that answered the question there.
Oh yeah. Nice. Beautiful. So as far as the setup is concerned of this trust, like obviously you must set it up, right? Like you're doing it, your office does it, right?
Yeah, so we have a team of professionals. So there's the law firm who we call the brain surgeons. They're the tax attorneys and CPAs, okay? And they actually do the surgery. Our role at Capital Gains Tax Solutions is the third-party unrelated trustee. So every deal requires a trustee that's not related party, right? And that's in it for business purpose. But I'm sort of like the offensive coordinator. So I'm going to connect with the business broker, with the syndicator, with with their lender, with their escrow officer. I'm going to connect with the tax attorney. There's a financial advisor also on all of these transactions. That's third-party unrelated. That's important as well. And we're all separate entities, but working as a team. And that's what maintains the integrity of the structure. One can't be the other. So the financial advisor can't be the trustee, and the trustee can't be the tax attorney. We're all separate, but it creates a protection for the client. And also the funds are held at some of the largest banks in the world, TD Ameritrade. Funds only move with your signature. And you have what's called audit defense in case you ever get audited. We survived 14 IRS audits. But all that being said, we just basically ask the client, what are they looking for? What's truly what would be transformational for them, right? And so for some people, they just want to retire. And in fact, according to the American Bankers Association, there's about $17 to $20 trillion that will pass from one generation to the next in the next 20 years. And this is the baby boomers, and it's known as the largest wealth transfer in the history of the planet. Okay, I want you to think about that.
Nice.
And they're faced with 30 to 50% in capital gains tax and depreciation recapture on these highly appreciated assets, okay? But it also has toilets, trash, and liability, and employees, and headaches. And at a certain point, they need or want to sell it. And they don't want to have to keep, building all of this. They're ready to retire and relax and be more passive. And in fact, there's about 10,000 baby boomers every day turning 65 in the US alone, and 77 million in the US alone. So you have this massive amount of wealth, this big, big problem, and they don't have a real clear solution. And unfortunately, the 1031 exchange, again, it's only a sliver for commercial real estate, but it creates what I call the 1031 rat race. You're always selling and buying higher, taking on more debt, selling, buying higher, taking on more debt, and more management, more responsibilities, more of all of this. And at some point, I may just want to say, you know what, Agostino, you're the multifamily expert and syndicator. Let me just sell my asset, put it into the trust, and I'm maybe not going to give you all 10 million, let's just say, but I'll start with $1 million with you with a syndication. And I might do a million in a mobile home park syndication and a million in a senior housing syndication. And I might put the rest of it in very conservative, allocation, stocks, bonds, mutual funds. I don't know. Whatever they want, we can customize that. One little caveat, 80% can go into outside deals such as real estate or a business. 20% needs to stay liquid, diversified, and investment grade securities. But the key is it just provides so much more than what the 1031 does and solves so many challenges that the 1031 just can't do.
Simply the ability to still have control over that money and still put it into other vehicles that can still earn or build wealth rather. And then I'm assuming then the trust can also take that money back and again, tax deferred, and you could just redeploy it again.
You got it. Let me give you the,
Beautiful.
I'll give you the, I always like deal stories because it brings it all to life. And we call this the Monday morning quarterback. And this gentleman in 2006 saw the writing on the wall, and he sold a big property in Minnesota, and he's a commercial real estate expert. I mean, he's worth over $100 million. And essentially he sold and he moved into the deferred sales trust, his asset, and his asset 5 years later was foreclosed on by the bank for the new buyer. And guess who the bank called? They called the old seller, and they said, "Hey, do you want to buy back your property?" And he goes, "Maybe. What's the price?" And they said, "Well, how about 40% less than what you sold it for?" He said, "Sure, I'll buy it. I'll buy it there." So he used his trust money to go back and buy his property at a discount, all tax deferred. Okay, he did not use a 1031. So he sold high, Monday morning quarterback. He played the play perfect. He dropped back 5 years later, just waited, and he bought back the same property at 60 cents on the dollar. And people say, that's just too good to be true. You can't do that. My commercial real estate broker didn't tell me about it. My CPA didn't tell me about it. I go, hey, look, I was in the same position you were. I sat at Marcus and Millichap in 2006, and I saw people get absolutely hammered because they overpaid for property in 08 and 09 and 010 because of the 1031. And some people lost everything, friends, family, clients. And we said, there's got to be a better way. And then they approached us. My manager brought this gentleman in who's my business partner, and they told us about this. And we sat there going, this is too good to be true. You can't do that. And they go, no, you can. It's in fact, it's a 90-year-old tax law. It's IRC 453. It's an installment sale. You guys know it as seller carryback, but there's a little nuance. There's some beauty in the simplicity of IRC 453. It just, most commercial real estate owners, the religion is commercial real estate. By the way, I'm a part of that religion. I love commercial real estate, right? And the doctrine, though, is 1031. They think it's just 1031. That's the only, you go, no, there's another doctrine here. It's IRC 453, an installment sale. And it gives you all these flexibilities. They're both tax deferral, but you got to understand the nuances. And so I started to study the nuances. And when I did, I said, you can actually do this. Now, it takes a team of professionals to execute this business strategy. And we've done a couple thousand of these now. And once you understand it and you get the team around you, you can execute these things. So that's what we provide, is that level of expertise and guidance to help you, really buy at optimal timing, which is, I think, the best way to create and preserve more wealth.
So here's the thing. I know we're talking about some big deals here. We're talking about multi-million-dollar, big, multifamily type style deals, right? How do you apply this same thing to, let's say, a guy that's starting out, all right, smaller deal, right? Where maybe he's got a fix and flip business or a wholesale business or something like that that's still looking to grow. How do they use this newfound information to help them build their business, defer their taxes, and help them scale so they can eventually get into something bigger?
Sure. Great question. So there's two places to that. So the first one is on selling, right? And so our minimum deal size is $500,000 of proceeds for every $100,000 of tax liability. Our average deal is about 2.6 million, and we're deferring around $400,000 or $500,000 in capital gains tax liability. Not to be confused with gain. Your gain, let's say, is 300, but your liability would be 100,000. It's about 30 to 50% of that gain, depending on what state you live in and whatnot. Now, so if you have a lot of properties, okay, and you say, well, Brad, I don't have anything that's 500. They're all, 100. Okay, well, do you have 5 100 deals? Yeah, I do. Okay, and collectively, are they adding up over $100,000? Yeah. So we can slowly roll in 5. We just we want the fees. We do charge fees. We want it to be an investment and not an expense. And the way we do that is we make sure the liability is big enough. So if you said, Brett, I'm selling my $300,000 house and I only have $25,000 of liability. Well, we say, Agostino, just pay it. That's too small. Once you pay our fee, it's going to eat up all of that savings. So first of all, we set those parameters. And by the way, we have a deferred sales trust calculator. You can go to our website, capitalgainstaxsolutions.com. You can answer 12 questions and it's going to give you a side-by-side comparison. But that being said, if you have more, then yes. And if you're going to be doing more, then yes. Okay. Now, the other way to do it would be on the other side, on the buy side. All right. So your listeners might be trying to buy from a mom and pops who are older, who are baby boomers, who've owned it for 20, 30 years, and who have been, very generous on the rents, and they haven't been marketing the property or managing it efficiently. They're just really kind and they're sweet people, and they don't necessarily need to make a bunch of money anymore, but they also don't want a 1031. And so when you're calling them to try to make a deal, guess what? You want to call them not to make a deal, but you want to call them to solve their problem. You want to call them to provide a solution to their challenge. And if you're calling them and just telling them to 1031 or telling them to Delaware statutory trust, which is, by the way, not to be confused with the deferred sales trust, just another form of 1031 where you give up all control. It's 10 years, high fees, you're locked in. Although it does have non-recourse debt. And I have done Delaware's as well. So there are places for that. But that being said, if you're calling them and offering what everyone else is offering them, guess what? They're not listening. They're not going to do the deal. Right. But if you can call them and say, hey, would you like to have liquidity? Yeah, I'd like to have liquidity. Would you like to have diversification? Yeah, I'd like to have diversification. Would you like to get out of all your debt? Yes. Would you like the opportunity to go back into real estate whenever you want? Yes. Would you like to have all of that? Yeah, that's often what they're looking for. The best place to be right now in this COVID-19 crisis situation is to be out of debt, is to be liquid, is to be on the sidelines with your powder dry, ready to go, right? That's the place you want to be. And that's where a lot of folks that are older too, they don't want any more headaches and they don't want any more debt. They already went through the '08 crisis and they're very concerned what could happen now in COVID-19. So that being said, call with the solution and then win that deal. So that $3 million deal, now maybe you buy it at 2.5 because they would have paid $1 million in tax, but you just saved them this and you provided the answer to their problem. And now they'll actually sell it to you. So those would be the two ways that I would approach it for anyone who's new.
It sounds to me, though, we could even go even smaller than that. Let's say, for instance, someone that has a bunch of flicks and flips and that kind of thing. Maybe they're using their self-directed IRA, for instance, to grow initially to get to that $500,000 mark. And then from there, they're able to call you, for instance, and then start using the trust method that you had mentioned before to really continue deferring their taxes and really build their wealth and also, I guess, pull money out, right? Is that accurate?
So self-directed IRAs, what's beneficial, and I have one of those, is essentially you're already kind of dealing with the taxes by deferring it, right? And moving it in there. And so you wouldn't necessarily need us for that situation. So if you're already self-directed, just roll it back into your IRA and keep that rolling. Now, if you go, well, I don't want to wait till I'm 60 to have to get the benefit of this. Like, I'd rather retire at 50. That's part of why I stopped doing my self-directed IRAs, because it was like, I want to retire at 45 maybe, or 50 or 55. Like, I don't want to be locked until after I'm 60, right? Or, whatever the ages are, like maybe I think it might even be 70. Actually, I might be off here. But essentially, if you're already in self-directed, just keep that flowing back there, keep that going. Now, if you want to cash out of that and then move it into a deal and then have a taxable event, then come use the deferred sales trust. Hopefully that makes sense.
And that's what I'm trying to get at, because what I'm thinking about is how to help someone, for instance, grow their wealth right from zero. If they're sitting at zero right now, how would they start with doing some fix and flips, building their wealth, having a nest egg, if you will, and then from there using the trust, buy an asset and pull all that into a trust and then continue growing from there, right? Because it sounds to me like a trust is going to be way more powerful than a 1031.
Absolutely. So we like to say we eliminate the need for the 1031 exchange, right? And it's basically how to legally break free from capital gains tax and find freedom to buy and sell a business or property without ever worrying about a 1031 exchange ever again. We have actually a masterclass on this that you can log in and for free if you contact me through Agostino and put his name there, where we'll show you videos on how to do all of this. But yes, so the key is defining what your wealth plan looks like. What does that look like for you? Not just financially, but lifestyle, right? And level of risk, and then seeing what tool is going to help me to get there. And that's where this tool can be used either as a business professional or as a individual, right? So whether you're a financial advisor, business broker, realtor, or you're an individual, you need to have you and your team know about this. Imagine not knowing about the 1031 20 years ago, August, and you're buying and selling multifamily properties and you're just paying all this tax. Like, I mean, how foolish would that be? Or how amazing would it be if somebody showed up and told you about the 1031, you go, oh my gosh, I can do this and I can just roll it. Yeah. So that's essentially where we're at. It's still very new to a lot of people, but you just got to get educated, and we want to empower you with the strategy, be your guide so that you don't ever have to feel trapped by capital gains tax ever again.
Well, I mean, that's part of it too, right? All this information you're learning today and 1031 exchanges and other methodologies of leveraging other people's money to get into deals. We as investors, we as syndicators need to understand all the different angles, every single one of them, because that's how we get to help people defer their taxes and build their wealth. Well, of course, we're building ours as well. Now, what is the difference then if I can go a self-directed IRA versus a trust? Because it sounds somewhat similar. So if someone out there is listening to this, they might be thinking, well, then why should I bother with this whole trust thing if I can just go with a 1031? Why should I bother with this?
Yeah, so let's cover 1031 versus the deferred sales trust, okay? So first of all, we already touched about optimal timing, right? Your parents taught us to sell high and buy low, not sell high and buy higher 180 days later. Okay, so think about that. That's what the 1031 often forces people to do. They're buying in the same seller's market that they just got this high price in. Now, they could maybe relocate to a different state or different place, but most people, they sell a single asset class in a single location or a single city, and maybe they sold 50 units and they buy 100 units, right? So they're a little more diversified because they have more units and there's more scale there. And I love that. By the way, if you can find a forced appreciation value add opportunity, by all means, with opportunity to grow the rents, go for it, right? I'm not excited about 4.5 caps, right? I'm not excited about 5 caps. I'm just not. I'm from California. We got 3 caps. It's crazy out here. So I just don't like to see people overpay for properties because they want to defer the tax. Like that's like the heart of, because that's where people got hammered in 2008. That's what I saw. People just lose everything. I'm going, oh my gosh, like I don't want ever that to happen again. So defining that versus the deferred sales trust, buy whenever you want. So that's on one side. Obviously the deferred sales trust wins there. The next one is the equal or greater value, which often means equal or greater debt, okay? So when you sell an asset, let's say for $10 million, let's make it smaller, $3 million, and you owe $1 million in debt, well, you have to replace that on the next property again, which means sometimes you're buying a $4 million deal because you can't find that perfect 3, and now you have another $2 million in debt, and you don't want that. So the idea is to be debt-free or go into debt when it's wise for you. We call that smart debt versus dumb debt. Dumb debt is doubling down, overpaying for property via 1031 exchange just to defer the tax. Smart debt is going into debt when it makes sense, when the market is lower, when it's more of a buyer's market, when the price per square foot makes sense, right? Then you want to leverage up. And that was, for us, it's like, really 5 years ago, 4 years ago, 3 years ago, but each year it's been diminishing. The last 2 years, it's like, whoa, what are you doing? Don't overpay. So one of them forces you into debt. The other one, guess what? You don't have to go into any debt. In fact, you can just retire all the debt and sit on the sidelines. Okay. The next one is the depreciation schedule. So we talked about depreciation earlier. So one of the reasons to own real estate is the depreciation it offsets. But guess what? If you own multifamily for 27.5 years, your depreciation goes to 0. Okay. Now, if you sell and do a 1031, guess what? That depreciation schedule travels. So let's imagine you had a $5 million asset and it was fully depreciated. You have a 0 basis. Well, if you sell for 5 and move it to another 5, 0 depreciation. That's not good. Now, if you sell and you move it into an $11 million deal, you've got an extra $6 million for depreciation now. But the solution is the deferred sales trust, because we want to get a full depreciation schedule. So we can buy that same property through the trust, just taking one extra step. And now we got a full brand new depreciation schedule, which is very powerful, right? If you think about it, because now you can offset a ton of that income, especially if you do like cost segregation. You work with one of our strategic alliances. We have specialists who are experts in cost seg, and they do that. So we touched on those three. Those are the main ones that I would say are and if any of those resonate, then dig into more with us and we can talk about even more. Actually, I'll touch on one other one. It's the partnership separation. So as a syndicator, one of the challenges is a lot of syndicators before they meet us, everyone brings their money. They already paid the tax. Now they're in the deal. They make a big gain and they send all of the individual money back to each investor and they all pay their tax, including the operator who pays on his own carried interest, pays the tax. Well, why? Well, because most syndications, it's too complex to bring in 1031 money, and it's also too complex to move it to the next deal. The whole entity must move with the 1031. And so when you combine those two, they say, forget it. Everyone just pay their tax and then come back on the next one. Well, the solution is the deferred sales trust. We can have 5 investors pay their tax and 5 do their own individual deferred sales trust, or 9 investors pay their tax and you, Agostino, just do it for your own carried interest in your own deal and defer your tax. And guess what? As soon as they're in there, they can all move it into your next deal anyways. And so we call this the seamless partnership separation. Very powerful and always worth taking a look at.
Why do you think that is, that it's not as well known as, say, a 1031 exchange or anything else like that?
It's a great question. So it's a proprietary structure that we protect, and we do that for 2 reasons. 1, we don't want competition, but 2, we also don't want anyone to mess it up. Okay. And by the way, we have over 1,000 strategic alliances: commercial real estate agents, realtors, business brokers, syndicators, CPAs, tax attorneys, national law firms. We actually partner with other people. So we're not like, hey, only go through us. No, bring your trusted advisors in, have them join us, and then you will all work together to make this work. But that being said, the 1031 exchange companies don't want you to know about this, and neither do the commercial real estate brokers. Why? Because they get paid on the 1031. Guess what? I'm a commercial real estate broker. I still do 1031 exchanges, right? I've sold nearly $100 million in multifamily, retail, industrial, office, land, senior housing here in Northern California. So I've been there, and that's to us, it's like gold. If you get someone who's a 1031 buyer, or you sell somebody, that's you got an opportunity to make a big commission, right? So unfortunately, that's just the nature of the business. They only get paid if and when they close a deal, and the deferred sales trust is essentially taking away that control and it's giving it back to the investor.
Right.
Okay. And it's parking it not in the 1031 company, although we can save a failed 1031. So if you're in a 1031, we can save that. And it's taking away from them making all of that interest on that money as it sits there. And it's putting it over here. Okay. And it's also not having any timing restrictions. You may not buy for 5 years, Augustino. Oh, by the way, guess what? You may not ever buy any real estate ever again if you're 70 or 80 years old. Right. Well, that's not good for the broker. Right. So that's honestly, I think that's one of the reasons. The other reason is the CPA, they're just general practitioners. A lot of them. I mean, they're specialists in, let's say, real estate or specialists in income tax returns, but they're not specialists necessarily in an installment sale. So it's kind of like a doctor. You go to your doctor for 20 years, Augustino, and they do your blood work and they give you your flu shot and they do general work. But all of a sudden you blow your ACL. Okay. You're playing basketball, and you're watching an old LeBron James playoff series against the Warriors when he wins, and you get inspired and you go to the gym and you blow your ACL. Okay. Now what happens? Well, you go to your general practitioner and he goes, okay, I don't do ACL surgeries. You need a specialist who just does that every single day and puts it together. So let me refer you to that person, and that's our brain surgeon. He does the deferred sales trust surgery, okay? But he may never have heard of it, or this surgery, or this particular procedure. Doesn't mean it doesn't work, right? And here's the key. We just say we stand on our track record. We've never lost a patient. A patient has never died on the operating table and has never gone to jail. Okay, what does that mean? Well, thousands of trust. 14 no-change IRS audits, which is very important. You need to make sure whoever tax deferral strategy you go to has been tested by the IRS and has a great track record. We'd say a perfect track record. You don't want any blemish at all. We also have a PLR. So we have the track record. We have 24 years of experience. The IRS knows who we are, okay? And they've gone through it all with us. So that's what we stand behind. And then you also have audit defense. So all that being said, the word is spreading, and it's continuing to grow. We're growing rapidly. I mean, we have I think it's over $4 billion in caseload that's in the system. That's all pent up. that people are looking at us, or either closing deals or going to be closing deals, and it's all there.
So now tell me, you've already referred to Robert Kiyosaki's book. Would you say that's your favorite book, or do you have something else? Like what's the type of book that really changed your life and really put you into a position of where you are now?
Yeah, so I'm a Christian. So besides the Bible and my Christian faith, which I read every day, for like a business or a leadership book, I really studied and have, I guess, been like a virtual mentor for Jim Rohn. I never met him, but he's passed away, but he's amazing. And it's ROHN. And there's a book called The Seasons of Life. And it really talks and it captures the human condition and the seasons that we all go through on different parts of our lives. And it's captured in the summer, the fall, the winter, and the spring. And essentially, how we pursue and how we persevere through these challenges. So right now we're kind of in the winter for COVID-19 in a lot of ways, for a lot of people, unfortunately, right? But a spring will come. But there's opportunities in the winter to go and prepare, right? And to clarify and to kind of cleanse our minds of what's happened and go back and become stronger because of it, right? And so The Seasons of Life, it's a pretty short book, but it's a book that you can continue to read and absorb. It's an amazing book. So I would recommend The Seasons of Life by Jim Rohn.
Excellent. Well, and there's also the personal seasons as well, right? I think that a big part of what we just discussed today is really in preparation for the winter of the individual, right? To make sure you have wealth and maybe even pass it on to someone else to make their springtime that much better, right? That's ultimately why I do what I do, man. I mean, I'm building this big portfolio of assets to not only help investors make money but also to build wealth for myself and my family. So, but I know that I'm not going to be around here forever. So it's one of those
we
things
call
I'm
that
doing.
the legacy, right? And we too are focused on helping people build their financial legacy, right? Beyond just their life, right? Which is the ability to give to charity, which is a good time to bring this up too. We're not a charitable remainder trust, but we're like a charitable remainder trust, except no C is required, meaning no charity is required. So most of our clients are charitable. They're just not 100% charitable. And so you can give 100% with the DST or 90 or 80 or 70 or 10%, whatever amount you want. It's very flexible and fluid. And also you can adapt it or change it along the way. And so that's a really a unique part about the strategy as well. So that if you think about this $20 trillion that's going to pass, right? If they just pay it all in tax, government will waste it away in about that fast, right? With, I think it's up to 25, 26 trillion approaching, right? With the new spending. Yep. And so instead we can keep that in our families, in our communities, right? And giving to causes that we believe in most, but also we can hold people accountable with the money that we're giving to these charities, right? And these organizations to make sure that they're doing the best for the most amount of people. But when the money is not in our communities or in our families, it's often, federal government land being wasted on who knows what, right? So that's a big part of what we're about here is not only providing freedom from capital gains taxes, but then empowering the individual to be able to give to the causes they believe in most.
Okay, if you want to reach out to Brett, you can reach him via his company website at capitalgainstaxsolutions.com. Hope you got a lot of great insight on how to protect your wealth. Take care of yourself, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.